5% or so. Krishna Kumar Karwa is our market master of the day. He's managing director of Emkay Global. Mr. Karwa, great to have you with us here. Good morning. If I can ask you to comment on this Paytm buyback subject, and theoretically, how do you think about this? You know, it's a digital company, platform company. Growth is supposed to be pretty strong, and here they are, 1 year after raising money, buying back at this valuation. We don't know, of course, at what price they will decide to buy, but obviously far lower. Your views?
Typically, I think not commenting specifically on any of the companies that you mentioned, but generally buybacks, corporates do indulge in them whenever, obviously, one is they feel that their share is undervalued. Apart from that, obviously, it is always a tax-efficient way of returning money to shareholders. Now, these are the two obvious reasons why we have seen buybacks from companies which are established companies with profits, etc. But as far as platform companies are concerned, I think they have been in this business as a listed entity not more than a year, and their path to profitability, etc., is also not exactly clear, but they are working towards it. And in those circumstances, if any of the companies are thinking of utilizing their cash for buybacks, I think it's a function of their confidence in their business prospects. It's also a question of that they may not require to burn further cash, and hence they believe that buying back shares at current valuations could be more attractive. But on a longer term basis, I think these companies have to deliver profitable growth for investors to value them on a long term basis. Any buybacks attempted just to give a short-term stability to the stock price may not work very long.
Okay. The stock, in fact, after the initial opening tick has come off a little bit. It's still up about 5-odd%, but let's see, it could be a very volatile run today for that stock. A couple of other names that I want to mention. You know, capital goods is coming back in a big way. L&T is at a fresh high. Cummins is up almost about 3-odd% right now. A couple of these others like Honeywell have done pretty well lately, so up almost about 2-odd% there. And not just capital goods, but many of these ancillary manufacturing companies are also doing quite well. So that's one pocket that has returned in a big way. For the market, the mid-cap index is the one that's really surging. And once again, no surprises. You have fresh highs on many of these banking names. Krishna, I just wanted to get you in on some of these spaces that are coming back, especially manufacturing, cement. Some of the cement manufacturers told us that both demand and prices have returned to stability, and demand is coming back in a big way. Capital goods, cement, would you add more to your portfolio at a time like this, expecting a big upside?
Yeah, I think the whole manufacturing space from a medium-term perspective looks very interesting. No doubt some of the stocks in the capital goods segment have done well and have appreciated by a reasonably large margin in the last 6 to 9 months. But cement companies, if you look at, I think they have corrected very sharply in the last 6 months. Last quarter was probably the worst for most of the cement companies as far as profitability was concerned. And now what I understand is that, yes, high input prices have started moderating and even realizations are improving. So from a medium-term perspective, maybe cement companies should be invested in. There will also be some action in terms of the smaller companies in play in terms of getting merged with the larger companies. So that is also an opportunity. But I think manufacturing as a space, it's not only about capital goods or cement companies, but even otherwise, the auto ancillaries, and the likes. I think the whole space is very interesting from a medium-term perspective. It is not only from a India perspective, but also from export opportunities for many of these companies.
Hi, Mr. Karwa. Morning. Since you spoke about the export market and the sector that has maximum global exposure is the IT space. Earlier today, we were covering news that HCL Tech now is guiding to grow at the lower end of what they guided earlier. I recall you telling us that some of the price correction is already in the price, and from here on, you would look at IT more constructively. Do you hold on to that view? And will it be only the large cap names, or are you looking at the mid cap IT names as well?
Definitely. I think there are two ways to look at it. From an institutional perspective, yes, IT companies could be looked at from investing perspective because the prices have corrected and these are huge cash generating companies. So institutions can't time it to the last T. So maybe in the next 2-3 quarters, they would see the business headwinds bottoming out, or maybe that is the reason they should be looked to investing in. From an individual perspective, yeah, I think they can time it slightly better. Let's wait for the quarterly results and guidances, and maybe the headwinds are still there. So have they got into deep value? No, not as yet. Are they fairly valued? Yes, definitely. And between large caps and mid caps, I think whenever there are headwinds in any sector, it is always better to be invested in the large caps because they have the resilience to ride the storm. The mid cap companies in the sector, if they, until and unless they have some niche products, then they will continue to do well. Otherwise, they will struggle for business. So if there are headwinds in the sector, then the Me Too kind of mid cap IT companies, I think they could very well be avoided. Their valuations will correct much more sharply than the large cap companies.
Okay. Just wanted to point out that some of these auto stocks have done a decent jig this morning, so don't lose sight of that. And in the broader markets, you have many of these names. There's Castrol India, there's Honeywell that's in the green, Craftsman Auto, Tube Investments. So many of these auto ancillary companies have also been picking up pace. CEAT is up almost about 2% now, and CEAT has had a 56% run this year on the upside. So it's had a fairly decent showing there. On autos, how are you feeling about the market now, Krishna? Because we were just having a conversation with Maruti where they said that demand is not too bad. Even in the lower end of the market, demand is picked up. Your thoughts here?
So on the passenger vehicle segment, we continue to be positive. I think the cycle has just started, and the cycle should continue for a few more years. So we continue to be positive on the passenger vehicle segment. And even the commercial vehicle segment, I think, has started to do better and should do well. As far as auto ancillaries are concerned, yes, they have had a good run, basis the positive upticks that we are seeing in the main OEMs. And also the export opportunities. I think these export opportunities are going to increase manyfold in the coming years. So we continue to be positive on the passenger vehicle segment, the commercial vehicle segment, and many of the auto ancillaries which have a size and scale not only in the domestic market but also in the overseas market. And as far as tractors are concerned, I think there are some headwinds, but the transformation that many of these companies are going through, and in terms of adding more agri implements and opportunities and export opportunities. So overall, if you look at it, the whole space seems to be very interesting. Yes, the stocks have done well, so you could see some consolidation. But from a medium-term perspective, we should continue to be invested. I am not so bullish on the two-wheeler segment, where I think there is a question of demand itself.
Okay, this question of demand itself. All right, just one word on, I mean, of course, we spoke about Paytm particularly, but in general for these platform companies, right, a lot of things are going wrong. Profitability is not back in a big way for most of these companies, barring a Nykaa, which is maybe profitable. But from a long-term investor standpoint, do you find value in any of these stocks, or is it a strict avoid for you?
Some of these companies, some of these platform companies have reached attractive valuations where there is a clear-cut defined leadership. I think those companies should definitely be invested in. And also companies where they have established their leadership, that is one point. And the second is, I think I'm very careful and cautious on fintech companies. I think that is one segment which I believe that the banks, the private sector banks will be able to duplicate whatever technologies, whatever new disruptions that these fintech companies bring into the system. They will definitely be with strict competition that they will face from the private bank. So fintech is where I would be very careful. But in other businesses, wherever market leadership has been established, you should look to invest in. Valuations have come down for many of these companies, and also the promoters of these companies have started talking the talk which public market investors like, which is a path to profitability and investing in businesses, but being very careful about how they burn the cash.
All right, Mr. Karwa, thanks so much, sir, for stopping by and giving us your view. Wishing you a good Friday, and look forward to chatting up with you rather soon. Well, for the markets, as we earlier stated, don't rush and buy the opening ticket.